Okay, welcome back. Today we're doing May-June 2022 question paper 14. This is quite a difficult paper. So this will be like the paper that you guys will sit in May-June 2025. It'll be a China-only component. And if it's as difficult as this one, then sorry about that. That's the way it is though. Alright, we're going to start from question 30. Government decides to borrow from general public in order to finance its extra spending on apprenticeship training schemes. What type of macroeconomic policy is being used? Okay, so first of all, financing extra spending, so that's government spending which is rising. Government spending which is rising is fiscal policy. To be exact, it's expansionary fiscal policy. And then spending on training schemes. So training schemes, what's that going to do? It's going to increase quantity, quality of resources. So that would make it a supply side policy, which is designed to increase aggregate supply to the right. So it's not going to be a monetary policy, but it is going to be fiscal and supply side. So A will be the correct answer there. What would be increased by an expansionary fiscal policy? So remember, expansionary fiscal policy, just like we said below, is government spending up, taxes down, right? So when we do that, that means that we're spending more and we're collecting less in revenue, which will increase a budget deficit. (28) An economy has a balance of payments surplus which it wishes to eliminate. In order to achieve this objective, which combination of policies would be most appropriate? Okay, so remember that you're trying to eliminate a balance of payments surplus. We're trying to reduce the surplus. And to reduce the surplus, in very simple terms, that means we want to have less exports and we want to have more imports. So we're going to be looking for policies that will allow us to either reduce our exports or directly to increase our imports. So first of all, if we have a depreciation of the currency, that is not going to work because that will increase our exports. If we have an increase in both direct and indirect taxation, that is also not going to help because we're going to be restricting our imports. Remember, we want to decrease tax rates to give people more money to spend on imports if we want to reduce a surplus. Increase in the money supply, but combined with a pay freeze. So combined with a pay freeze would be ineffective or not the most appropriate. The pay freeze wouldn't allow for more imports to happen. Whereas if we have an appreciation of the currency and we reduce the interest rates, the reduction in the interest rates is going to increase consumption and investment. The appreciation of the currency is going to directly result in us reducing our exports and increasing our imports, as our imports become cheaper and our exports become more expensive. And the cut in the interest rates may allow more consumer expenditure and borrowing and investments, and therefore it may directly impact on us importing as well, let's say raw materials from another country. Okay, so that policy would have to be B. What is an accurate statement about possible causes and or consequences of a worsening in the terms of trade? Okay, so remember, like we said before, terms of trade are worsening. Terms of trade is the index of export prices divided by over the index of import prices. If the terms of trade is worsening, that means that the prices of exports are falling relative to the price of imports. So prices of exports are falling. Why would that happen? Well, we can see straight away here that it would be A, because if we have a fall in the demand for exports, just think about a regular demand and supply diagram. What happens when the demand for something falls? The price drops. Right? So as the demand for our exports drop, the price of our exports will fall, and that will be a direct cause of the terms of trade worsening. Okay, the others here, increase in consumer incomes in major trading partners, they'd be willing to pay more for our exports. That would not worsen a terms of trade. Decrease in interest rates by major trading partners, again, would not have an effect. It will result in an improvement in balance of trade. No. Okay, so direct cause, fall in demand for the exports. Okay, question 26. Country has a floating exchange rate. An increase in which variable in the country will cause its currency to appreciate? Okay, so an increase in what? Now, if you had a look at the slides on the exchange rate chapter, you would have seen about, well, in the current account, really, you would have seen this in the current account balance of payments section when we talk about how we use monetary policy to address deficits and surpluses. And we always say that the biggest variable that we have is the interest rates, because they're the hardest thing to control, essentially. Right? So if we have an increase in the interest rate, it will cause the currency to appreciate in value, right? So by increasing the interest rate, we're essentially making it harder for people to borrow. When the currency appreciates in value, it will directly work against the increasing interest rate that we're trying to have when we are trying to address the current account imbalances, right? So to know this one, remember that the interest rate is the biggest variable that we have when it comes to either causing an appreciation or a depreciation in the currency. Okay, budget deficits won't affect it. Price level will not affect the currency to appreciate or depreciate, and trade deficits will also not do the same. Okay, if we increase the interest rate, that's the one that affects it the most. It has a direct effect on it. Question 25. Currency of country X has a floating exchange rate against other currencies. Under which circumstances will the value of country X's currency fluctuate the most against other currencies? We've got PED and we've got PES. Okay. This should be very straightforward, because if you understand the theory about PED and PES, there's demand, there's supply. If both of them are inelastic, they're very responsive to changes in price. So any change in demand or any change in supply will not have a great effect on the quantity that is being traded on the market, but it will have a big effect on the price of the market. And that price will determine whether it is appreciating and rising or whether it is depreciating and falling. So if both are inelastic, they'll be very responsive to changes in price, which means that the currency will fluctuate. It will appreciate a lot or it will depreciate a lot, just based on small changes in demand and in supply. Okay, 24, very straightforward. We've got AD and AS diagram. Sustained rise in the prices of imported raw materials in which the economy depends. So price of raw materials goes up. We depend on those raw materials. That means that our aggregate supply shifts to the left. It causes cost push inflation. And if we can recognize that, then we can see what happens here. We can see that the price level will rise from where it was previously, and we can see that our national output will drop, right? AS will therefore decrease, price level will rise. So that leaves us with C. Okay, 23. Again, this is resulting, or this is about the winners and the losers of inflation. So what is a likely consequence of inflation? Fixed income earners gain more than those whose income is gained from the ownership of property. Okay, definitely not. If we have inflation, the fixed income earners are definitely not going to gain more than the people who have their assets invested in something illiquid, which is not cash. The value of property may still rise over time more than inflation. They're more likely to gain more than the fixed income earners. Real wages will definitely not rise more than money wages with inflation, at least, no, in all circumstances, because money wages are nominal, and we'll always be taking away our money wages from our inflation to get our real wages. So even if our money wages increase by 10%, if we have inflation of 2%, the money wages would still be more than the 8% rise in real wages. Domestic purchasing power of money increases. That's definitely wrong. Purchasing power always decreases. It has an inverse relationship with inflation. When we have deflation, purchasing power can increase. So the only one that's left, and that makes sense, is that the assets of creditors decrease in value at the expense of those of debtors. Now, if you think about it, this is a very fancy way of saying lenders and borrowers, essentially, which is what we know about the winners and the losers of inflation. The debtors are the ones who are going to benefit, because the value of what they're paying back will be less in real terms after the inflation happens, because the value of the money will continue to decrease. Whereas the creditors who are receiving those funds, they might have made an agreement with the debtor at the time, and then for them the value of the money that they're receiving is much less than what it would have been prior to inflation. So that's essentially the lenders and the borrowers that you think about when we talk about winners and losers of inflation. Okay, 22. Diagram shows a freely floating foreign exchange market in the United Kingdom for the demand and supply of pound sterling in exchange for United States US dollars. What would cause the downward shift shown? Well, we can see an increase in the supply, right? So we see a change in the supply of pounds. So first of all, correct answer here would be C. Demand for US exports is price elastic and prices decrease. So if the demand for exports is price elastic and the prices decrease, then the US exports will become more attractive to people in the UK, and they will sell more exports from America. That will mean that more pounds will be exchanged on the market to be changed into dollars, and that will decrease the price of the the dollars per pounds and result in that depreciation happening, as more people are exchanging their pounds and the demand for dollars is increasing. Okay, so because remember, we're looking at the demand and supply of pound sterling. For D, if people believe that the sterling will appreciate, then they would not be selling the sterling. First of all, there would be an increase in the demand for pounds if there was speculation that the pound or the sterling or the pound would actually appreciate. So there is no change in demand here, so we know that's wrong. UK interest rates fall below US interest rates, so that would be the same thing. US investments would therefore become more attractive, so there would be a decrease in the demand for pounds. For B, the demand for UK exports is price elastic and prices increase That would also reduce the demand for pounds. Prices increase and it's price elastic. They would become less attractive for people in the US who'd be buying the exports from the UK. So demand would shift left for pounds. Okay, 21. Trade weighted exchange rate is not something that's come up. I need to double check if it is still on the syllabus or not. I don't believe it is, but what we'll do is we'll do the question anyway. So, because it's relatively simple and it's worth knowing in any case. So they conduct 60% of their trade with country Y and 40% of their trade with country Z. Initial value of the trade weighted exchange country X is 100. What will be the new trade weighted exchange rate value if the currency falls in value by 20% against country Y? Okay. So for country Y, trade weighted exchange rate is a very simple calculation. So it's the proportion of trade that we have with country Y, which is 60%, multiplied by the change in the currency value, which is the depreciation of 20%. Multiply those two and what we get is a negative change of 12%, or 0.12. Country Z, do the same thing, the proportion of trade, which is 40%, multiplied by an appreciation, so a positive number of 10%, that gives us a positive 0.04. Okay, those two are added together, so minus 0.12 plus 0.04 gives us minus 0.08. Now that 0.08 represents a 8% reduction. Let me just move that up a little bit. So represents an 8% reduction. Now we know that the initial value is 100. So very simple. 100 minus 8%. 8% would be 8 of that. And that would leave our new trade weighted exchange rate value at 92. Question 20. Which statement correctly describes how an import quota works? Okay, very simple. Remember that an import quota is about a limit. Okay, it is limiting the number of imports that can come into a country. So it is not a ban on the import of demerit goods. That is what we would call an embargo. It is not strict product regulations. That would be artificially high quality standards. They are both still forms of protection for A and B, but they are not an import quota. A unit tax is a tariff. Again, another form of protectionism, but not an import quota. But it is, as I outlined here above, it is a limit on the quantity of certain imported goods. Okay, question 19 might trick you out a little bit, but if you know your elements of the current account, then you should know how to put these together. Okay, so which change will not affect the balance of payments current account? A rise in export and import prices will, because it will affect the balance of trade and the balance of trade in good and the balance of trade in services. A rise in foreign aid flows will, because it will affect the secondary income account. And a rise in international exchange rates also will, because again, that will affect our import and our export prices. So those two are highly correlated. So what we're left with is a rise in foreign direct investment. Okay, now it will be included in the balance of payments. It just won't be included in the current account. So foreign direct investment may be included in capital or financial accounts on the balance of payment. But thankfully for you guys, we don't really need to know that. We just need to know about the elements of the current account and the balance of payments. Question 18. The government introduces taxes on company profits. 5% tax rate is levied on all profits up to first 10,000, and a 10% rate is levied on all profits above 10,000. How would they be described? Okay. So you might think they're progressive, but they're not, because everybody who is earning up to 10,000 is paying the same percentage of tax, right? So everybody is paying 5% on that, and everybody who is earning above 10,000 is paying 10% tax on that. Okay, therefore that would make them both proportional. Okay, because a person earning 5,000 is still paying the same percentage in tax from their income as a person who's earning 8,000. They're both paying 5%. Person who's earning 20 or 50, they're both paying 5%. So that makes it proportional in nature. Because remember the definition of proportional, progressive, and regressive. It's to do with the percentage that they're paying as their incomes go up or go down. If the percentage they're paying stays the same, then it makes it a proportional tax. Okay, the market for good X is in equilibrium. Government then introduces an effective minimum price on good X. What will decrease as a result of this minimum price? Okay. So very simple. Remember what a minimum price is. Minimum price is placed above the equilibrium. Just draw a simple diagram here. It results in a contraction in demand and an extension in supply. Okay, so what will decrease? It does not decrease the excess supply, it actually creates an excess supply, and we can see that from the diagram. It does not decrease the market price of the product, it increases the market price of the product. And it does not decrease the quantity of the product supplied, it increases the quantity of the product supplied. What it does decrease, however, is the size of the consumer surplus, which we can see here. Remember, the consumer surplus previously, for example, would have been all of this area in here above the equilibrium price, which we'll just label as P, to the top of the demand curve. When we instigate the minimum price, all we're left with is this area. So we've lost this area in here before we instigated the minimum price. What would be the result of a subsidy that is given to the producers of a good with an inelastic demand curve? Okay. So if we've got an inelastic demand curve, it will look like this. We've got our supply curve. Okay. And then we've got a subsidy that's given, so supply will shift to the right. So what will happen if we label it here? Let me change the color quickly. Just draw these diagrams, it just makes it so much easier to answer. We can see a big decrease in price, and we can see a small increase in quantity. Okay, so what we've got to do is match that up. The equilibrium price of the good will fall by a larger percentage than the rise in equilibrium quantity, which is exactly what we can see here. Price change is much bigger as a percentage than the now increase in the quantity. Question 15. What would be a valid objection to the government provision of goods and services? First of all, for A, that can't be right, because if there's an increase in consumer sovereignty, that's a good thing, so it wouldn't be an objection in the first place. Only the private sector can provide merit goods. Again, that's not true. Sometimes there's arguments that are made that we need to provide them as governments so that we can actually obtain the external benefits that they generate. The tax rates and the tax income are likely to fall from the government providing goods and services. not really true. In fact, they're likely to rise because of the fact that we'll need to obtain the funds to be able to provide them. Remember that government provision of goods and services is financed from taxation. So the tax rates and income are not likely to fall, they're likely to rise as we're looking for additional funds to fund this provision in the first place. A valid objection would be that the investment in the private sector might be reduced. Because we're providing the goods and services, it offers less opportunity to the private sector, and that might reduce the investment from their side. Money is paid by the government to an unemployed worker in the form of a benefit. Why is this called a transfer payment? Okay, now you might think it's A, but remember, we've done these questions before, right? So, payment comes from taxes paid by employed workers. Could be true, might also not be true, right? But the payment is made without the production of goods and services taking place is the correct answer. B and D are way out of the equation, okay? Remember that when we talk about a transfer payment, we call it a non-productive form of payment, or a non-productive means of payment, which essentially just means that we don't do anything in order to receive that payment. We're not involved in the production of a good or a service in order to obtain an income to receive a payment. We are doing nothing productive in order to receive it. Okay? So remember, non-productive forms of payments is the first thing you think about when you see a transfer payment. A very common MCQ question, that one. Demand and supply diagram. Cost of raw materials for manufacturing watches rises, so supply will shift left, will end at B. Same time, the incomes of the rich increase, they're going to buy luxury watches for sure, so demand will shift right and will end up at B. Okay, very simple. 12. Price of good X rises, total spending on good X rises. Okay, so what does that tell us? That tells us that X must be inelastic. Okay, because price goes up and total revenue goes up. So therefore we can straight away get rid of A and get rid of B here. Price up, total spending rises, yeah. Demand for good Y falls, okay. What can be concluded? So remember that for the cross elasticity of demand, or for XED, if that's how you think about it, you do need to know both the abbreviation and the actual full name. That formula is the percentage change in quantity demanded of good A divided by the percentage change in the price of good B. So therefore we're told that the price of X has gone up, but that the quantity demanded of Y has dropped, right? So therefore, either way, right, one is up, one is down, it's going to result in a negative figure being the answer. So that will leave us at D. Okay, where it'll be less than 0. It'd be plus 0 if the demand for good increased, and therefore we'd be showing, for example, that there's a substitute relationship, but these must be a complementary relationship, because we know that they have an inverse relationship between the price of good A and the quantity demanded of good B, which will indicate to us that the XED value will be a minus. Price elasticity of demand for a high quality smartphone is elastic. Price of the smartphone decreases. Okay, price goes down, it's elastic, so quantity demanded should go up by a greater percentage than the price fall, and the total revenue should rise. So that will leave us with B here. Okay, very simple. Remember, elastic, price down, quantity demanded up by more than price, total revenue up. Inelastic, price up. Quantity demanded will, elastic, price up. Quantity demanded will go up by a greater percentage than the quantity demanded will drop by a greater percentage than the price increase, and the total revenue will fall. Elastic is price up, total revenue is the opposite direction. So price up, total revenue down. Price down, total revenue up. And inelastic, price up, total revenue up. Price down, total revenue down. Question 10. Okay, tickets are priced at P1. It's anticipated that demand will be Q1. There's a discount for those that buy tickets in the first hour who will pay P2. All tickets are sold in the first hour. Okay, how much the consumer surplus was increased by. So remember, the initial consumer surplus would have been this area in here, P1X1X. When the price drops, the consumers are gaining an extra surplus from P1 to P2, including the area of X2 into X1. Right, so that black area there is the gain in consumer surplus. We just match that up, and that would match up with C. Okay. Remember, consumer surplus is always the area above the equilibrium price to the top of the demand curve. Each day there are hundreds of airline flights. Which combination would make the demand for flights most pricing elastic? So remember, pricing elastic means that they are they're not as sensitive to the price changes. In other words, like if the price goes up by a lot, they're still willing, or they're going to be willing and able to pay. And their demand will not change significantly if the price increases by a lot. So therefore, obviously, we'd be looking for a high income traveller. And we'd be looking for the purpose of flight to be business, because they would definitely be more pricing elastic than leisure would be. And that leaves us with the distance of the flight being long. Okay, in this case we're looking for the people that are not going to be as sensitive to the changes in price. They're still going to be willing to demand it. Okay, the distance of the flight is long, there's likely to be less substitutes available in the first place. Purpose of the flight is business, they're likely to be less sensitive to changes in price, and if their income is high, the proportion of income they would spend on the service would be smaller, and therefore, the proportion of income they would spend on it would be smaller, and that would make it more inelastic. Okay, question 8. SX, SY, and SZ are the supply curves of goods X, Y, and Z. Price of all three goods rises from $5 to $10. What's their PES value? Okay, very simple question. I won't spend too long. I've told you guys about this I don't know how many times. We don't even need to look at these curves, because we can see all of these curves originate from the point of origin. Anytime they originate from the point of origin on a PES curve, immediately it makes them unitary. And if they are unitary, their values are always equal to exactly 1.00 for PES. So equal to 1, equal to 1, equal to 1. Okay, done. We don't even have to spend time calculating it. The percentage change in quantity supplied, if we calculate it because they give us the values, they'll all work out equal to 1. But as soon as we see coming out of point of origin, straight away, finish it, and you're going to save an extra 2 minutes to give you more time for other questions. What is likely to decrease the PES of a product? Okay, increase in advertising. Remember that advertising affects the PED. An increase in the firm's ability to substitute capital for labour. Okay, that's going to increase their PES. Right, so not decrease their PES, because it will allow them to make goods quicker. Increasing the time during which a product can be stored, that will also increase their PES, because when the market conditions change, they'll be more responsive, as they will be able to hold a greater level of stock and therefore release that to the market. But if there's an increase in the time required to produce the product, then their PES value will decrease. It will become more inelastic the longer it takes to make a product. Question 6. A change in which factor will be least likely to alter a consumer's ability to pay for a product? Okay, so consumers' income definitely will affect their ability to pay. A fall in the tax on goods and services definitely will, because it's going to change the price of the product, which also will affect it. The one that is least likely would be consumer tastes. Consumer tastes will more alter not their ability to pay for a product, it will alter their preference for a product more so, right? So it will alter their perceptions of what products to buy, not necessarily their ability to be able to pay. Whereas their income or the price that they're paying will directly influence or be correlated towards their ability to be able to pay for it. Okay, good X and good Y are complements and have upward sloping supply curves. What will be the effect on the equilibrium price and quantity of good X of an increase in the supply of good Y? Okay, so if they are complements, good X, increase in the supply of good Y. Okay, so for good Y, increase in the supply, so good Y will have price goes down and quantity traded goes up. So therefore for good X, because they're complements, what we'd expect to see happen in good X is there's an extension in demand here, right, for good Y. So we would expect to see a shift in demand for good X, and that will increase the price and increase the quantity of X that is traded as well. Question 4. Professional gardeners now use power tools instead of hand tools to maintain their customers' gardens. What can be concluded from this information? Okay. Capital has replaced all labour. Well, that's not true. They still need to have the gardeners. Gardening has become more labour intensive. That is definitely false. Land has become more productive. We can't say land has become more productive based on the information we've been given. New technology has been introduced. That one would definitely make the most sense, right? They're now using a power tool instead of using hand tools. Question 3, please ignore. Old syllabus. Question 2. Farmer with a fixed area of land grows 2 crops, wheat and barley. Some land used for barley is flooded and can't be used. Farmer then starts to plant genetically modified wheat, produces wheat more efficiently. Okay, so some land that is used for barley is flooded and cannot be used. Therefore, what we would expect to see is we'd expect to see a decrease in barley. Okay, as they use genetically modified wheat, we'd expect to see an increase in the PPC for wheat. So we're expecting a shift in wheat, that's what we're looking for, from XX to YY, okay? So XXYY, for A, wheat goes down. So straight away we know that's not correct. Wheat also goes down for XX to YY in B. So again, not correct. For C, decrease in barley, increase in wheat. So that should be our answer. And for D, increase in wheat, but barley stays the same. Yet we're told that barley would have to decrease because there's some land they can no longer use. So how could their how could their ability to produce the same amount of barley be the same if they're using less land? Okay, and last question. What will result from a government's decision to allow healthcare to be provided entirely by market forces? There will be a reduction in the provision of a public good. Not necessarily true. Okay. Remember, public goods are funded from taxation generally. They're provided because they're non-excludable and non-rivalrous. Just because we allow healthcare to be completely dictated by the private market, it doesn't have any ability, or it doesn't mean that we're going to reduce providing public goods. In fact, we may be able to provide more public goods in other areas because we don't have to provide them in, for example, that healthcare industry. All consumers receive better healthcare? Maybe, but we can't say for sure that they definitely will. Market failure will be eliminated? Definitely not. There will still be some form of market failure because remember, the healthcare market is healthcare is a merit good, just like education. They generate external benefits. If they're provided by market forces, they will only take into account the private benefits and the private costs. They will not take into account the social benefits, which means that they will be underconsumed when they're provided by market forces. But the healthcare will reach an equilibrium? Yeah, sure. There'll be an intersection of demand and supply, which may be below the socially optimum level, which the external benefits are generating, but it will reach an equilibrium because the market forces and the price mechanism will work to determine a demand level and a supply level at an equilibrium price. Okay, and that's it for this paper.